The firms are evaluated and compared to all other large United States stocks. We use 4 factors to measure valuation: price to sales, price to earnings, free cash flow to enterprise value, and EBITDA to enterprise value. The factors are equally weighted in the calculation, giving us a diversified measure of cheapness. This brings us to the key question: is this actionable information? That is, do these high-conviction firms perform better than the market? In Table 1, the high-conviction firms have delivered significantly better results. Importantly, they have also delivered much more consistent results. Table 2 shows the percent of rolling periods, 1 year through 10 year, in which the different categories have outperformed versus an equally weighted benchmark of large United States stocks. When evaluated through the lens of absolute excess return, risk-adjusted return, and consistency of return, the high-conviction buyback firms do quite well. Building a strategy to take advantage of high-conviction buybacks. Because buybacks have become such an important tool for returning capital to shareholders in the United States, we believe that, when measuring yield, buybacks must be included alongside dividends. This combination, which we call shareholder yield, is the best way to identify firms committed to returning large amounts of cash to shareholders. Currently, buybacks dominate the highest shareholder yields. Indeed, among the top 50 large United States stocks ranked by shareholder yield, the average firm has repurchased 8% of its shares in the past year. Historically, a strategy that simply selects the 10% of United States stocks with the highest current shareholder yield, rebalanced on a rolling annual basis, has outperformed an equally weighted large stock universe by 3.7% per year since 1963. Despite its compelling historical performance, we believe that shareholder yield is best used in combination with other factors. Specifically, cheaper valuations and higher quality should be favored over more expensive valuations and lower quality. The combination of these themes has led to impressive lifetime results. Conclusion: the common criticism of share buybacks is that they are myopic and mistimed, and that the money should be allocated toward capital expenditures and research rather than toward boosting short-term stock prices. At the broad market level, and also for many individual firms, this may be true. Buybacks peaked in 2008 at what turned out to be an inopportune time. But most of the money spent on buybacks is put forward by firms buying back a fairly low percentage of their shares. On the other hand, firms with high conviction have tended to buy back shares at much cheaper relative valuations than others. In turn, these high conviction firms have gone on to outperform the broader market by large margins, on average, and have done so consistently since 1987.